Hi, welcome back. In this session, I want to focus on valuing high growth firms, a build up from valuing startups, which I did in the last session. High growth firms are a little further along the life cycle than startups. What makes them different? They have a business model. It might not be delivering profits yet, but it's a working business model, delivering a product or service. They're expecting growth to be stratospheric, but they're still losing money. They have limited history, so you can't really draw from history. And the question is, how do you attach a value to these companies when you have very little history and lots of potential? Let's recognize what it is that makes it difficult to be a high growth firm. As you scale up, it gets more difficult to grow at high rates. It's a mathematical problem, it's a scaling problem. One way to see the effect of scaling up is to look at growth rates of firms based on what their revenues are. So what I've done in this graph is looked at the revenue growth rate of firms for firms broken down by the level of revenues, from smallest revenues to biggest revenues. You're probably not going to be surprised by what I find. The revenue growth rates are highest for those firms with the smallest revenues, and as revenues get larger, revenue growth rates decrease. You're saying, what does that tell me? When you value companies, you got to keep that in mind. Because when you value companies, you scale up the revenues, especially if you're upbeat about the company. You make their revenues become larger over time, which is okay. But as their revenues become larger, you have to think about how much growth rates will decrease because you're building off bigger scale. And there are some added challenges. And one way to see the added challenges you have with high growth companies, especially young high growth companies, is to ask the four questions. What are your cash flows from existing assets? What's the value of growth? How risky are you as a business? And when will you become a mature business? Let's start with the first one. What are your cash flows from existing assets? The way we usually get the answer to that is by looking at the existing financial statements. It's true that young high growth firms are a little further advanced than startups. There's a little more substance. You have some history. But there's not much you can learn from that history other than the fact that the revenues are growing fast. Most of these companies are still losing money. You're not getting much of a sense of what they will look like once they become steady state or mature companies. So there's not much information in the existing financials about where these companies will end up in terms of profitability. In addition, as with startups, young high growth firms tend to pay their employees with options, with restricted stock, with equity. And that can put a dent in your earnings and make it much more difficult to decide for what the company's end game is going to be in terms of profitability. What's the value of growth? Remember, we said the value of growth comes from how much you reinvest and how well you reinvest, or more directly in terms of what you can earn as a return on your reinvestment relative to your hurdle rate or cost of capital. Mechanically, that's going to be true for every firm, but with mature firms, you have history to draw on to get a sense of what kind of returns you make on projects. With young, high growth firms, you're just starting the journey. You have a business model, but you don't have much of a history in terms of projects. Managers tell you that they can make high returns, but you have no basis for it. It's much more difficult to gauge the value of future growth. How risky is this business? Again, you have some history now with young, high growth firms relative to startups, but the history is limited. If the company is publicly traded, it's probably been traded only a year or two. There's not much earnings history, so you're getting a much more difficult terrain to estimate risk. And when will your firm become a mature firm? Even though a high growth firm has a business model, it's made it through that first round of survival. There are plenty of hurdles ahead of it that could get in the way of it becoming a steady state going concern. So young high growth firms might be easier to value than startups, but you still have issues. So what am I going to do? I'm going to take young high growth firms to the 5-step process that I took startups through. Remember, that process started by telling a story. With young high growth firms, I start with a story. And that story is built around the business model that I can now see that the company has come up with, and how that business model is going to play out in terms of scaling up growth, in terms of profitability margins, and in terms of how much will need to be reinvested to deliver that growth, which will tell me how efficiently this company is growing. Well, with high growth firms, while you're spinning that story, you are focused on potential, You now have some substance. You have a sense of what the company has done since its startup days. You have to give some weight to the financial history of the company. Not too much, but some weight. And you also have to look at the corporate governance structure. Who's managing the firm? Are they capable of building the business model they've just described to you? In some cases, as you look at that, you're going to get more enthusiastic about the story. You like the founder, you think they have the capacity to build a business model. In other cases, you might get more skeptical. The founder tells a good story about a business model, but doesn't seem to have the capabilities to deliver on it. Which brings me to the second step, the 3P test. Is it possible? Is it plausible? Is it probable? So first question you're going to ask is, as the founder, as the owners of this high growth firm, as the managers of their publicly traded companies spin a story about high growth in the future, the question you're asking is that a plausible story? It might be possible, but is it plausible? Because ultimately that story of growth is built around how big the total market is and what your market share is going to be. You're going to gauge the story on, hey, can the market be as big as they describe it to be, and can they deliver that market share? On the profitability angle, again, managers and owners might deliver a story of high profit margins. You should listen, but you should check out that story, maybe stress test it based on the unit economics. Even though the company might not be making money right now, you can look at what it makes on the next unit it sells. Gross margins rather than operating or profit margins, and trend lines in margins. And finally, growth is never free. A company, a high growth company that spends all its time telling you how much they will grow and doesn't mention how much they will need to reinvest to deliver that growth is telling an incomplete story. Your job is to push back and ask, how much will you need to reinvest to get that growth? And that growth has to be tied to revenue growth, because after all, that's the ambition of the company, is to triple, quadruple, increase revenues tenfold. You say, how are you going to do it? What is the pathway you're going to adopt? Which brings us to the third step in the story. You're trying to convert the story you've heard into inputs into valuation. I'm going to go back to my parsimonious valuation model. Revenue growth, operating margin, reinvestment. Let's start with revenue growth. When young high growth companies describe their potential, they often talk about the revenue growth they had in the most recent year. And it'll look impressive, 200%, 500%. But before you take those growth rates and run with them, remember that when you're a very small company growing, it's easy to deliver 500% growth. If you're starting with $1 in revenues, getting to $5 or $6 is a huge revenue growth rate. So as you forecast the future, I have a couple of suggestions. One is, look at the historical growth rate, but rather than just input it as your growth rate for the future, look at what it translates into in terms of absolute revenue changes. Percentages can be deceptive, especially when you're scaling up. So think in terms of absolute revenue changes. I'll give you an example. Let's say last year's revenue growth was 50% and the company went from 5 million to 10 million. From 10 million to 15 million. It increased revenues by 5 million. If it maintains that revenue change of 5 million next year, which is pretty impressive, right? The growth rate will now become 33.33%. So one way to think about growth is, rather than just run with percentage growth rates, check out what the absolute revenue changes are by year. Look at trend lines in historical growth. If the growth rate last year was 50%, but the year before was 200%, there is a lesson there that you might want to incorporate in your forecast of future growth. And finally, look at the business itself. If you're a fast-growing business in a mature market, you have to be a little more pessimistic about future growth, because you're now trying to get market share away from others. The overall market is not growing. In contrast, if you're a fast-growing company in a fast-growing market, you get more leeway in attaching a higher growth rate. So look at absolute revenue changes, look at trend lines in past growth, look at what the sector, the market itself is growing at. Which brings us to a second stop. When you try to gauge what the operating margins will be for your company, you're going to be looking at one of two pathways. The most common one is, your company right now is a money-losing company. It's either got negative operating margins or very small positive operating margins. And you're trying to gauge, What will the margins look like once you get through the growing pains? It's a tough call, but here are some of the things you might want to look at. If a company has a lot of upfront fixed costs to get started, creating a platform, building a plant, its pathway to profitability might be easier because it has economies of scale working in its favor. As it grows, because most of its costs have already been spent, the fixed costs took care of it, you should see a much faster rise towards profitability. Second, when you look at the expenses, take a look at whether those expenses are expenses associated with the units you sold right now, which are operating expenses for delivering revenues, or expenses that are really associated with future growth. If your salespeople are spending 80% of their time cultivating clients for the future, that salary you pay those salespeople might be an expense this period, but I'd be much more upbeat about that company than another company where all the expenses are associated with what they're selling right now. And third, there are businesses where there can be a lag between when you spend money and when you show revenues. What does that mean? In these companies, you're going to see bigger losses up front, especially if they have ambitions of growth, because they're spending the money for growth 3, 4, 5 years from now. With technology and pharmaceutical companies, especially young ones, R&D takes this form because accountants expense R&D, and R&D is really about growth 5 or 10 years from now. So if your margins are negative or very small and you think they will improve, those are factors to think about. There are some uncommon cases where you can have a young, high growth company which has margins that are too high. You think, how can that be? You serving a niche market, you're the only game in town. You have pricing power, you get high margins, but you have ambitions for growth. That growth will require that you leave your niche market and go into markets where you will not have the pricing power you have in existing markets. There you might want to look at industry averages, other companies in that space to get a sense of where you're going. So revenue growth, operating margins, let's talk about reinvestment. When you're looking at reinvestment for young, high growth companies, my recommendation, because the margins are changing, is to focus on revenue growth rather than earnings growth. Don't tie reinvestment to earnings growth, tie it to revenue growth. In fact, the ratio that I find most useful in estimating reinvestment is the sales to invested capital ratio. It's actually a very simple ratio of what your revenues are to invested capital in the company. Invested capital is what you put into the company, and if you think in accounting terms, it's your book debt plus book equity minus cash. The same invested capital used to return invested capital. You're saying, what does that tell me? When you have a high number there, when you get a high sales to capital ratio, you are more efficiently delivering revenues. So a company with a high sales to capital ratio will be able to grow with less reinvestment, which makes it a more valuable company than a company with a low sales to capital ratio. Now, before you decide that high sales to capital ratio is good, therefore you're going to use it, remember you're constrained by the business you're in and what you can do. So I would strongly suggest you look at your company's own data to see what it's had to invest to get to where it is today. Remember, you're a high growth company. You might have been around 3, 4, 5 years. Look at the company's history, but don't get carried away. It's a limited history. You might also want to look at industry averages. If you're a retail firm, you're a young high growth retail firm, or a young high growth or software company, you're not reinventing the wheel. You can look at other companies in the space further down the life cycle to see what their sales to capital ratios are going to be. And finally, there are businesses, as I said, but there's a lag between when you reinvest and when you get revenue growth. That's easy to build in. If you think there's going to be a 5-year lag, here's how you'll estimate reinvestment this year. You look at the growth you're projecting for your company between years 5 and 6 and use that to estimate reinvestment this year. Revenue growth, margins, reinvestment. Let's close the process by bringing in risk. Now, rather than delve into the details of cost of equity, cost of debt, and cost of capital, you've heard enough of that to get bored. Here's my basic point. Your cost of capital for a high growth firm should adjust over time as you change your firm. In other words, you've got to be internally consistent. What does that mean? If you start your valuation with 80% growth and your company is a money losing company, I would expect it to have a high cost of capital. But as that company grows over time, its revenues go up and its margins become positive, it's now a large money making company, I would expect its cost of capital to decrease because both the cost of debt and the cost of equity will get lower if in fact your projections play out. In addition, remember, if you're going from money losing to money making, and we talked about in the context of corporate finance, these companies should be able to carry more debt than they used to. Your debt ratio might change, which will also play out in your cost of capital. Put simply, when you're looking at valuing a high growth firm, I would expect to see your cost of capital change over time to be a year specific number as you approach closure. What's closure? Every story needs closure. You got to tell me what your company will look like in steady state. Steady state being once you've gone through the growth cycle and you're a mature company, what will it look like? Now, a couple of pieces of advice, because this is actually going to be change across companies. When you're looking at a young, high growth company, you're going to get caught up in the mood of the moment, the management optimism, and you want to give them 25, 30, 35 years of growth. Just remember history. It's very difficult to keep growing at high rates for long periods. For a couple of reasons. One is, as you get larger, it gets more difficult to maintain high growth rates. And second, as you grow and become profitable, your competition notices and come for your market. So most companies find that they start off with high growth rates, but it becomes very difficult to maintain those growth rates. I'm going to give you a historical factor to consider in terms of how long growth should last. I've looked at growth periods for high growth companies in the US historically. The median growth period for a high growth company in the US is about 3 to 5 years. 10 years puts you at the 90th percentile of all high growth companies. In my intrinsic valuation, I usually cut off growth at 10 years, make the company a mature company. And I'm often accused of being pessimistic. But I'm putting you at the 90th percentile. Are there companies that have grown for longer than 10 years? Absolutely. And we can name most of them, which tells you what? That they're the exceptions rather than the rules. If you value a company to be the exception, where's the icing on the cake for you? So don't wait too long before you put your company into stable growth. And when you put your company into stable growth, give it the characteristics of a mature company. What does that mean? We talked about cost of capital already. Your cost of capital might start off at a high number because you're a young money losing high growth company. But by the time you get to stable growth, that cost of capital should be approaching the median cost of capital for a mature company. With reinvestment, the reinvestment should come down as your growth comes down. That's why you tie reinvestment to growth. And finally, there are analysts who argue that in stable growth, in steady state, all companies should earn their cost of capital. The argument is no company can earn excess returns forever. I buy into that. But in practice, I think we need some flexibility. There are some companies that can earn more than their cost of capital for very long periods. And since you're not forecasting cash flows for those very long periods, you're stopping in year 10. With some companies, I think it is reasonable to assume they can earn more than their cost of capital in closure. So in step 3, you're basically taking your story and converting into inputs. Those inputs will translate into cash flows or terminal value, traditional discounted cash flow valuations driven by your story. And here again, I'm going to mention something I mentioned in the context of startup companies. The terminal value will be a high percentage of your value today. 80, 90, 100, even more than 100%. In fact, some analysts use this fact as ammunition. And they argued that because the terminal value is 90% of your intrinsic value, why bother with the forecast for the high growth period? It doesn't matter anyway. All of your value comes from the terminal value. That's not true. And here's why. Your terminal value is driven by what you have as earnings in your terminal year, your cash flows in your terminal year, in year 10. But remember, to get to year 10, you got to forecast out growth for the next 10 years. If you use a higher growth rate, you're going to get a higher earnings in year 10 and a higher terminal value. Changing your assumptions about high growth will change your terminal value. So don't fall for the hype. You'd still need to pay attention to the high growth period because that's what leads you into your terminal value. And as with your startups, once you've finished your valuation, especially if the company is publicly traded, you compare the value to the price, one of 3 things is going to be true. Actually, one of 4 things. Maybe this is one of those unusual companies where the value is equal to the price and you can walk away. But let's take the scenario where the value is different from price. There, one of three things is going to be true. The first is that you're wrong. Your assumptions, your story about revenue growth, margins, reinvestment are wrong, and the market is right. The second is the market is wrong and you're right. That takes a bit of an ego because you're saying, I got this right, the market's got it wrong. And the third, which is the most likely scenario, is you're both wrong, but one of you is less wrong than the other. I'm fond of a saying that you don't have to be right to make money. You just have to be less wrong than everybody else. In my intrinsic valuations, I start off with the presumption if my value is different from the price that I've missed something. I go looking for it. And if I can't find anything, then I stick with my conclusion. The stock is under or overvalued. But that's a 5-step process applied with high growth companies. I'm going to apply this process to Tesla in November of 2021 when the company was reaching for the sun. The company had taken off during COVID. It'd been a darling for markets for a decade, but COVID put it into hyperspeed, and its market cap had just exceeded $1 trillion. So it was leading in from strength. The market clearly loved the company. The price had hit $1 trillion. And I was curious, is the stock really worth $1 trillion? Now I have some history with Tesla and I'll take you through. But in 2021, the wind was behind Tesla's back. Its market cap had gone up because its fundamentals reflected a company that had grown from nothing to being one of the most successful automobile companies. You could see this in its revenues. Its revenues in 2019 were $6.3 billion. By 2021, they'd more than doubled. But the most impressive thing is this company, which had historically never made money, finally turned to a profit in 2019 with a $261 million operating profit. And that operating profit went to more than $2 billion in 2021. The company is getting larger, but more impressively, as it's scaling up, it's also getting more profitable. You can see why the market's so excited. Now, let me give you my Tesla stories over time, because I have valued Tesla since 2013. And I'm never shy or reluctant to admit that my stories can often be wrong, and I revisit them. In 2013, when I valued Tesla, I valued it as a luxury automobile company. The point about being a luxury automobile company is you're not going to sell as many cars as a mass market auto company, because that's what I saw. I came up with a value of about $12 billion. The market cap was $20.5 billion. I concluded it was overvalued. In 2017, when I revalued the company, my target revenues, I believe that it was starting to expand out of its niche. Its potential target revenues would be much larger. My story got more upbeat on revenues. My margins were about the same. But my value went from 12 billion to 33 billion. You're saying you changed your mind? Yeah, I did. But the market value went from 20 to 57 billion, still overvalued. In June of 2019, Tesla was going through some serious troubles. I revalued it. My story actually got more expansive, bigger revenues, but my margins got a little lower, 10% was struggling. The value that I got for the company was about 4 billion, just a little bit more than my 2017 numbers, but the market had gone from 58 to 31 billion. Stock, for the first time in my valuation of Tesla, it came out as undervalued. I bought Tesla for the first time in 2019. In 2020, when I revalued it, I gave it a much bigger story. It had done really well in that intermediate period, that 6-month period. I raised its margins. My value went from 34 to 84 billion. That's a pretty big jump. But the market price went from 31 to 102 billion. The stock went from under to overvalued. My point about intrinsic valuation and pricing is they both change over time. Your intrinsic value is going to change because the facts change, your story changes, the data changes, the market inputs change. But the price also changes. Investing is about buying something when it's undervalued. The price is less than the value, and that can shift over time. So when I valued Tesla in November of 2021, I had to build up to my Tesla story. So I'm going to build through the process so you can see some of the things I looked at to build up to the story. I start with revenues. And with young high growth companies, one of the things I've learned over time is rather than try to project out revenue growth starting year 1, year 2, is to step back and ask, what will the revenues for this company be if my story comes through? In other words, visualize what success will look like for this company if your story is right. So if you think about the revenues, the question I'm asking is not what will the revenues will be next year in 2022 or 2023, but what will they be in 2031 or 2032? And here are your choices. You can go with about 100 billion if you think it's going to be more luxury than mass market. If it's a mass market automobile, it could be 200 billion. If it's a mass market leader like Volkswagen or Toyota, it could be as large as 400 billion. If it's a mass market automobile company that actually dominates the car market, in other words, most cars are electric cars and Tesla gets a 25% market share, it could be 600 billion. And if it could, if it becomes the winner take all, a dominant market share company, it could be $1 trillion. What I'm trying to say is, you could tell me a growth story where Tesla revenues get as large as $1 trillion and it would be plausible. Maybe not probable, but plausible. Because the automobile market is a really big market. 86 million cars were sold in 2021. And if Tesla can get a 50% market share, it could get up to $1 trillion. And this is not even counting the supplemental revenues that Tesla can get from software and add-ons and other products and services. So that's the first step in the story, is look at revenues, craft a revenue story. And I'm going to tell you what my revenue story is going to be, somewhere between the 100 billion and the 1 trillion, depending. On margins, if you think of Tesla as a traditional mass market automobile company, you're trapped because the margins for those companies, even well-run mass market auto companies, are in the single digits, 8%, 9%. The median US firm is about a 12% margin. The very best manufacturing firms have margins of 16%. If you're a consumer product company, your margins can be as high as 20%. The big drug and technology companies have margins closer to 24%. And if you're a successful software company, your margins can be 28, 30, 32%. What I'm trying to show you is the range of margins you're going to see in the market. And the question you're asking is, where would I put Tesla here? It depends on your story. If your story is it's really a mass market automobile company that does what other mass market automobile companies, you're kind of trapped around the 8 to 10%. If you can craft in your story a way in which Tesla becomes a dominant automobile company while changing the way cars are made, better unit economics, its margins could be higher. If you come up with a story where Tesla's revenues become a significant portion, maybe even 20, 25% come from software, that will augment the revenues. Already you can see the end game for Tesla will depend on where you put it. And one of the things in Tesla's favor is in 2021, as they improved their margins were pushing towards a very top end of the automobile sector. They had changed the way cars were made, and that's got to be factored in. On reinvestment, remember the sales to capital ratio captures how much you reinvest, and the higher that number, the more efficiently you're reinvesting. Again, to gain some perspective, infrastructure, heavy capital intensive companies tend to have sales to capital ratios less than 1. Normal efficiency manufacturing companies, you can get up to 2, but normal efficiency superior efficiency manufacturing companies, you get $3 of revenues for every dollar of capital. And as you move away from manufacturing to less capital intensive businesses, you might get $4 or even $5 of revenues for every dollar of capital invested. Again, you can look at Tesla's history. Tesla's history historically have delivered about $1.7, but it's improved over time. You look at the marginal sales to capital ratio. What's the marginal? You look at the change in revenue sales, the change in capital and the change in revenues each year. They've been able to deliver about $3 of revenues for every dollar of capital invested. So that's going to have to factor into my final numbers. And finally, with Tesla, there's a question of risk and personality. Again, to give you perspective, you look at the cost of capital, and this was in 2021 when risk-free rates were low and risk premiums had come down. The typical tech company had a cost of capital of about 70%. The 80th risk percentile for all companies was about 8%. The typical US company had a cost of capital of about 6%. That looks low. It was at the time that I did this valuation, November 2021. Risk-free rates had dropped and risk premium is low. The largest automobile companies in November 2021 were closer to 5.2%. The riskiest companies, the 90th percentile, you are getting a cost of capital of 9%. What I'm trying to do is frame the cost of capital discussion. I'm not going to be using a 15% cost of capital for Tesla because that would be out of the spectrum. The question is, where between the 5 and the 9% would I put them in terms of risk? And here again, if you look at their existing cost of capital, was actually not that high. It was about between 6 and 7%. And there's a factor with Tesla that has to come into the valuation somewhere. This is a personality-driven company. When I say Tesla, admit it. A name comes to your head, right? Elon Musk. This is a company where its founder and the founder and the company have been aligned at the hip, which means that what happens to Elon Musk will affect Tesla. And Elon is a mixed effect. He is a positive force. He's a visionary I think a visionary that essentially has enough vision to cover 100 companies. That's a positive force. He's built this company from nothing to what it is. There is Elon as a negative force, which is he gets distracted and sometimes steps on his own story. And there's Elon as a neutral force. The question is, in your story, where would you put Elon? So already you can see that you can value Tesla and I can value Tesla. We'll get different values, not because we disagree about a growth rate or a margin, but because we're telling different stories. So here was my Tesla valuation, November of 2021, for better or worse. Stock was trading at about $1,200, 1.2 trillion, roughly speaking. The value that I came up with was 571, but rather than focus on the value, I wanted to focus on the story I've told. In my story, I think Tesla's revenues, which were about 50 billion at the time that I looked at this, would grow to about 420 billion over the next 10 years. Let me pause right there. Am I being upbeat? Of course. It's a big story. And if you remember the spectrum of revenues from 100 billion to a trillion, I'm putting them right in the middle. This will make them the largest automobile company in the world if the bulk of their revenues come from automobiles. Their margins, I think, will improve over time, and in my story at least, their margins will converge on 16%. That margin will make them the highest. So I'm making them the largest automobile company in the world with margins much higher than a typical automobile company. Upbeat story. And along the way, I think initially at least, they will be able to benefit from the fact that they've already built up capacity. The Shanghai plant had come online, so at least for the next 3, 4, 5 years, they'll be able to get their revenue growth with relatively little reinvestment. So you see that with a sales to capital ratio of 5 for the first few years, but over time, I think that will have to come down to something more reasonable. And in steady state, they will be able to earn a return on capital higher than their cost of capital. I did give them a cost of capital very close to that of a median company. By the time I looked at Tesla in November of 2021, they were not a small money losing company. They were a large money making company, and I gave them the cost of capital of a median company. Am I telling an upbeat story? Absolutely. Largest automobile company in the world with margins that would match that of the very best manufacturing companies, not just automobile companies. A cost of capital which is close to median, and superior efficiency in terms of their delivering growth. And at least in my story, Elon Musk is more neutral to positive than neutral to negative effect. It is my story, and my value of $571 reflects that story. My promise, even with that upbeat story, I'm at a value half the stock price. Am I wrong? Is the market wrong? I did not buy Tesla in 2021, obviously, but I did not sell it short. What does that tell me? I believe I'm okay. I'm okay with my own valuation, but I'm not willing to take that value and bet on it by selling short because I don't control my time horizon. But I hope at least this valuation gives you a sense of how to value a high growth company. Don't get focused on historical data. Have a vision of what success will look like in your company. Build a story, convert to inputs, value the company, compare to the price. Make your best decision and move on. Now, in terms of pricing high growth companies, the big challenge you face is often when you look at high growth companies, You're not going to see positive earnings, or if you do, the earnings are going to be too small. Book value is often going to be a hazy number, which leaves you often with revenues as your scale are. So often with your high growth companies, you'll see revenue multiples. My suggestion if you use revenue multiples is that you use enterprise value in the numerator, market value of equity plus debt minus cash, rather than market cap alone. And if you want to use forward numbers, that's an alternative that you can think about, is maybe you can use forward numbers because those might provide more substance about your company. Now, the big factor when you're comparing high growth companies to other companies in the sector is if you have high growth in your company and the other companies have lower growth and more mature companies, your high growth company is always going to look expensive on a pure pricing basis, PE ratio or enterprise value to sales. Growth is not part of that multiple. Maybe if you can bring growth into your multiple, you can incorporate growth and you can try. There's a ratio called the PEG ratio. You take the price earnings ratio and divide by the growth rate. So if your price earnings ratio is 20 and your growth rate is 10%, 20 divided by 10 gives you a PEG ratio of 2. In contrast, if you're another company with a price earnings ratio of 50 and your growth rate is 30%, 50 divided by 30 is 1.67. You've effectively been able to incorporate growth. I don't like PEG ratios for lots of different reasons, but you can see what people are trying to do. So I did try to price Tesla in November 2021. And you shouldn't be surprised at what I found. What you're looking at here is traditional multiples, EV to EBITDA, EV to sales, EV to, and price earnings ratio for all automobile companies, and Tesla's in the mix. These are actually the 20 largest automobile companies. And let's face it, if you just look at pricing, Tesla looks incredibly expensive on every multiple. EV to sales, EV to EBITDA, price earnings. Notice there's one other company that also looks expensive, which is BYD. Not as expensive as Tesla, but BYD is the Chinese electric car company. Put simply, if your metrics tend to be old-fashioned metrics, and I'm not using old-fashioned in a bad way, it's just metrics we're used to using, Tesla would have looked expensive. Now, if you did PEG ratios, you're saying, would that change? Not by much. You still have a PEG ratio of 7.54 for Tesla. It incorporates a higher growth rate. It's now less overpriced than it was before, but it's still overpriced. So basically, whatever you try here, you still are faced with the challenge of, how do you justify buying a high growth company? And you can see why traditional value investors who are so focused on PE ratios and price to book ratios will never be adding a BYD or Tesla to their portfolios. It is, I think, a problem because it means you might be rejecting some of the most successful stocks in the market from your portfolio, but it's a natural outcome. Now, just as an add-on, growth, of course, is the key part of your high growth company's story. And while many investors view growth as an unalloyed good, I think I've made the case strongly enough that growth is a trade-off. There's a good side of growth. Your revenues and earnings become larger. The bad side is you need reinvestment. And at least when you look at it in a big picture perspective, the value of growth really depends on what you earn on that growth, what kind of return on equity or return on capital. Because that return has to be greater than what you need to make. So if you are growing and creating value, it's because you earn a return on capital greater than the cost of capital over time. If you grow and you earn less than your cost of capital, you're in effect destroying value as you grow. So as you think about that, it's worth also remembering how difficult it is for companies to beat their cost of capital. And every year I actually look at return on capital and cost of capital for every publicly traded company in the world. This is tens of thousands of companies. And then I chronicle what percentage of companies globally earn more than their cost of capital. This is just to make you aware of how difficult it is to beat the cost of capital. These are the 2021 numbers across the globe. 57% of companies earn less than their cost of capital. Now, many of them have excuses, right? Had a bad year, I'm a growing company, but this is a daunting statistic, and I'm willing to stand on it because it's, I've done it every year now for more than a decade, and every single year the statistic has been more than 50%. Most companies globally have trouble earning their cost of capital. What does that mean? Be more skeptical about growth stories. Check the story out. It's not just that there's growth, it's what you need to reinvest to deliver that growth that's going to create your value. And if you look across industries, and I do this every year again, there are some industries where it's very difficult to earn more than your cost of capital. In fact, I've listed out the 10 best and the 10 worst businesses. And I define worst and best by comparing return on capital to the cost of capital. Now, you might be surprised at the worst industry of all, which is biotech, but there I think there's an excuse. These are mostly young companies, and remember what we said about return on capital at young companies? But businesses like, metals and mining, air transport, I think the basic business is a tough one to earn cost of capital in. And if you're valuing a young, high growth mining company, you got to factor that in. You got to be a little more skeptical about growth and build in more reinvestment. The best businesses, you see a much higher percentage. And again, you're going to be surprised. The very best business in the world is the tobacco business. Unfortunately, there's not a whole lot of growth in that business. But my point here is when you look at a company, you need to look at the business it's in to make a judgment on what can you assume in your steady state for that business. Now, in terms of uncertainty, in the session on startups, I talked about using Monte Carlo simulations to deal with uncertainty. Here's a second way in which you can deal with uncertainty. You can look for break-even points. What does that mean? When you're valuing a company, if growth is your key inputs, you can look to see what growth rate will deliver a value equal to the market price. My preference is rather than focus on just one variable, holding everything else constant, which is what you do in a traditional break-even. Now focus on a couple of variables. My preferred variables are revenue growth and margin, that combination that delivers value. And look at what combination of these variables gives you a value equal to the price. It'll make you more aware of how as your story changes, your value changes. In fact, you can be explicit about different stories for Tesla and how they will play out in value. Just to get a sense of break even. Now, what would need to happen for that $1,200 stock price to be justified? I looked at the break even in terms of my end revenues, between 200 billion and a trillion, and target margin. So if you ask me, is it possible Tesla is worth 1.2 trillion or the stock is worth 1,200 per share? Yes, it's possible. It's a weak word. But to get there, they would need 600 billion in revenue and 24% margins, or 800 billion in revenue and 20% margins, or $1 trillion in revenue and 16% margins. If you think that is a path that your story can take you to, all the more power to you. I don't own the story for Tesla. It's my story. It gives me my value, my estimates, and you have to make yours. I hope you found this session useful, and I thank you very much for listening.